again and welcome. This is Robert Schein, Managing Director, Partner, Blanke Schein Wealth Management. Today is Tuesday, September 2nd of 2022. And let's get down to our three topics of the day, and thanks for watching. So we'll start off with a special announcement. I will be appearing on CNBC this Thursday, September 29th. It's going to be an early call here for those of us, especially me on the West Coast. It's a 2 a.m. call for me, but it's a 5 a.m. Call for the East Coast. So either way, we'll have the clip. We'll send it out later that day. So I'm not going to be recording an update, but today, let's go into today's update for you. So let's jump right into it today in our three topics. So first and foremost, right now, Fed. We got a lot of Fed speak this week. In fact, the Federal Reserve has used what we call the jawboning effect, or the ability to talk rates up higher, lower, or at least let the markets and communicate to the markets a little bit more clearly between press conference to press conference. Now, keep in mind, their next meeting isn't before the next election, which is early November. In the meantime, we get a lot of data points. So there's going to be a lot of noise and a lot of numbers. And I think that's what we're going to have the Federal Reserve and all of the cronies, all the Fed presidents go out there. In fact, this week we have 24 speaking. In fact, this morning it was market moving. That's why we pay attention. Markets moved up on Chicago's President Evans, who basically said he is worried. He pulling an Alfred E. Newman, what me worry? He did crack and say he's worried that the Fed could be going too far too quickly, which means that right now we've already had 375 basis points right now, and we have scheduled to have a lot more, at least in the back end between now and year end in terms of interest rates. Now, the question is, and it's what I said in my insights and observations, even at the very beginning of the year, as we saw all of this play out, and then we positioned accordingly as best as possible for our clients, but very specifically, the Federal Reserve was raising interest rates, and they were going through this series of the stock and bond market early on, the crypto market early on, or right after that, and now the real estate market. Now, is there any evidence as to is there policies, or are there policies actually impacting the economy and impacting slowing down the velocity of money? Raising interest rates doesn't really do much, but it basically sucks out the liquidity effect, and it slows down. It's almost like a governor on your golf cart. If you're speeding along, it slows down and kicks in. And that's what they're trying to do, to slow this economy without breaking it. And essentially, you're seeing all walks of the market, from the Forex market, which is the exchange, the US dollar is all-time highs. Again, every which way to the Treasury market, again, yields are rising once again. Now, where does this settle? How does this shake out? Well, let's keep our eyes on what the CPI report is going to tell us this Friday, because that's the inflation reading, and the core CPI is important. Good news is that some of the reports that we've been receiving month over month or week over week are showing that there are signs that inflation is moderating, which that translates into the Federal Reserve will not have to be as hawkish as previously anticipated, predicted, or projected by what we're seeing in the fixed income market, specifically the 2s and the 10s on the Treasury market. We also want to pay attention to, in October, the first week of October, we got a lot of data. That's important. It's not the noise, it's the data that we want to pay attention to, and those numbers for the inflations. Now, keep in mind, the Federal Reserve is looking for the job openings to come down and then unemployment to go up. That's the last linchpin here. They need employment to basically reverse. In fact, we don't have a tight labor market for them to be happy. They'll be hawkish if that continues. So we see any signs of basically a slowing in the job market, or even opening up maybe more opportunities versus the supply and demand equilibrium coming back in line. Again, that would be extremely bullish for the market, extremely helpful for the Federal Reserve, knowing that their policies are impacting. Now, are their policies actually impacting? Absolutely, absolutely. We just saw that Case-Shiller report this morning, that overall we're down 2.3% month over month in terms of pricing. So prices are coming down. Now, does that actually mean something? What does that mean? Yes, if you look at the GDP, the gross domestic product, about anywhere from 15 to 18% of our GDP is related to housing, anywhere from housing starts to building permits to all the way down to the home improvement store, to everything as it relates to housing. So there's a lot of GDP, and they want to slow down the market, they want to slow down the economy so that inflation doesn't get ahead of itself. And there's a lot of signs that we're seeing it in the high frequency data, from cars to commodities to even lumber prices, going back to housing. They're back to pre-pandemic basically levels. Remember how lumber went up 40%, or super crazy numbers? Those numbers have come back down. Again, signs that inflation is moderating. And that is a good thing, because we believe as soon as the Fed pivots or pauses, we could see the equity markets return to an upward trend. So right now we're in the middle of the S&P, the NASDAQ, really breaching and going through the June lows. We want to make certain that they close above those lows. So in the intraday lows, yes, we're testing them right now. So we have to see how we close. When you're in a bear market, you also have to see how you close on Fridays as well. So we'll be monitoring that, but we're positioned according to either way. But yeah, the real estate is just showing that month over month decline is having an impact. As we described, as if you're following along, this is playing out slowly but surely, but the Federal Reserve is actually making an impact. And, in our channel checks for the small business owners that we have as clients as well, there is a slowing down effect out there. So we should see that translate into numbers. But what are we going to pay attention to? CPI this Friday, October, first week in October, the jobs numbers that come out. And then finally, as soon as we are done with the third quarter, we're going to be anticipating earnings. And we believe at Blanke Schein Wealth Management that earnings will come in better than expected, adding more support for the market moving forward. So that's our update for today. Again, tune in early morning on CNBC on Thursday morning if you want to catch me. Again, it's 5 a.m. Eastern, 2 a.m. our time. I don't think I'll be sleeping. I'm just going to have to stay up all night and get prepared. But thanks for following along, and we'll see you again next time.